Are you an entrepreneur? So you need funds to run your business, right? For your information, in the financial system, companies are structured by either debt and equity or 100% equity. So to raise your capital, you may choose between debt or equity. Over the years, debt has been recognized as the most favored capital financing. However, debt has been found as the root cause of global financial crisis on 2007 to 2009 since it incorporates fixed payment of interest which cause a burden for the companies to repay their debt. So, researchers argue that equity financing is the best alternative to replace debt. As opposed to debt, equity has features of risk sharing and return flexibility, whereby when a project is unsuccessful, investors will share the risk of default with the equity holders and the company is not necessary to pay the returns to both of them. Thus, the company can still use the remaining funds to continue the operation and sustain in the long run. Due to these arguments, I come up with this study idea of comparing between three financing models. The first financing model is the combination of debt and equity. The second model is the 100% equity, whereby the return follows return on equity ROE benchmark. And the third model is the 100% equity, whereby the return follows new Malaysian overnight rate MYOR as a transaction-based benchmark. So how's the models works? First, a company borrows some amount of money from the bank if it issued the first model, or from the investors if it issued the second or third models. Second, the company funds a project with that amount of capital. Third, if the company issued the first model, the return follows current interest rate. For the second model, the return will be based on the project's performance, and for the third model, the return follows new MYOR benchmark. Fourth, the company make monthly payments to bank or investors. And lastly, the company pays earnings residual to the equity holders. Besides, from the investor's perspective, investors make investment decision based on risks and returns of the project. Let's say a project is unsuccessful and the company issued the first model, the company may not be able to pay fixed payment to the investors, which then cause financial distress to the company and hence bankruptcy. Meanwhile, if the company issued the second or third models, investors will share the risk of default with the equity holders. So, to come up with the analysis of risk and returns of the models, this study runs Monte Carlo simulation on each of the financing models. Lastly, this study has theoretically explained the danger of debt in the financial system. And I hope the result of this study can improve sustainability by helping market players and researchers to be better understand the advantages and return flexibility associated with the equity financing.